Okay, hello everyone, and welcome to TIN Apply's latest, the European Road Freight Rate Benchmark Q1 2021 webinar, where we'll be talking about the latest developments in European road freight rates. My name is Michael Clover, I'm TI's Head of Commercial Development, and I'll be hosting today's webinar session. Just before we get started, I think it's probably worth doing a bit of housekeeping just to say that all today's slides and the recording of the presentation will be made available to attendees and registrants after, so you'll be sent those. Don't worry too much about that. And also we would love to hear any of your questions anytime during the webinar, so please enter those in the Q&A function on Zoom, and we'll answer those in a dedicated session at the end. The overall session presentation will run for about 25-30 minutes, and then we'll do a 10-15 minute Q&A session with you at the end. Now, today, of course, we're going to be focusing on rate development through Q1 and the major factors influencing those rates. Of course, for many of us in Europe over the last few months, we've been experiencing a new set of lockdowns in response to coronavirus, and learning to manage that as we all have over the last few months, and looking at how that's really affecting rates and disruption around borders in terms of European road freight as well. That's been coupled, of course, with Brexit finally coming into effect in January, and all the disruption around border crossing and channel crossing from Dover to Calais. And the effect that's had on rates. So it's led to a fairly disrupted quarter, and today we're going to be trying to bring out the effects of that on European road freight in the data that we'll share. So I'd like to introduce you to our other panelists today. I'm joined from Transport Intelligence by Andy Rawls, one of our senior quantitative analysts, who's instrumental in working on this presentation and delivering our wider road freight market research and market intelligence to the industry. Hello, Andy.
Hi, Michael. Hi, everyone.
Then I'm also joined by William Begley from Upply, or an expert for Upply, who's able to provide his views on the road freight market for us today. Hello, William.
Hello, Michael. Hello, everyone.
And finally, as always, I'm joined by Thomas Layou, who is the Chief Data and Research Officer at Upply, and he'll be able to provide more detail on Upply's business, but also tell you a bit about how they compile the data that we'll use today and deliver it to the market. Hello, Thomas, and would you like to just give us a quick introduction about Upply?
Yeah, with pleasure. Hello, hello everybody. So Upply is, we've been partnered with Transport Intelligence for more than a year, I think now. And the objective of Upply is to provide to our users, let's say, a benchmarking solution, a way to analyze and to compare the market rates on the supply chain industry. Here we will focus on the rates regarding road transportation in Europe, but we also provide some rates in air freight and sea freight on a worldwide basis, and also road transportation in the US. And the basic idea of Upply is to get invoices and transactional rates from its partners and users, to collect it, to clean it, to gather it, to offer to our user the ability to in a simple way, let's say, search for a specific origin destination with some specific shipment information, and then see what were the market rates in the past week. But we will see that just after.
Yes, thank you, Thomas, for that introduction. So in that case, let's get to some of that data and see what Upply are actually able to tell us about the market in terms of the data that's available. And I think we'll start with the overall average European road freight benchmark here, which we can see, is pushing up towards rates not seen for a few quarters now in terms of price increases. So Andy, could you tell us a bit more about that?
Yes, you're right. We're up 0.5% from the previous quarter and 1.6% year on year. And in terms of the demand picture, in some ways it's been a bit disappointing start to the year. The vaccine rollout failed to pick up much pace across Europe. That and the new, more infectious variants have led to a third wave, with new lockdowns and public health measures have acted to depress consumer demand relative to expectations, which obviously affects import demand there as well. However, global trade levels overall have increased rapidly, and that's boosting intra-regional supply chain needs, and that demand is driving higher rates in some cases. We've also seen the Brexit effects as well. It appears to have been a key factor in raising the benchmark rate this quarter. We're hearing some mixed signals on cross-border routes. For instance, the Kent access permit is now gone since most hauliers seem to have the necessary paperwork. But undeniably, there have been teething issues which have led to more trucks crossing the border empty or experiencing delays. I mean, I think more generally as well, supply chain disruption is playing a part. We're seeing congestion at ports, scrambles to get sea and air freight capacity, and a shortage in some quantities and key components such as semiconductors, for instance. And this is pushing pricing power towards carriers. Apart from that, we've also had diesel prices that tend to have a bit of a lag on rates, but they're also increasing, and this is influential. So overall, we've seen perhaps a depressed demand picture relative to expectations. We'd hoped for quite a big pickup, but it's been depressed relative to what we were hoping for. But overall, there's been a number of factors really which have pushed the rates higher into Q1.
Yeah, and it's certainly interesting to see, even though there's been a weaker demand picture, then perhaps we'd hoped that some of those other complicating factors and disruptions have had a material effect on rates, pushing them up overall in Europe. But of course, later on we'll get into some more of the detail when we look at individual lanes. And actually, on that subject, looking at the broader European picture, we can see this nice map here, which just shows us some of the major lanes and the prices between different countries listed there. Also gives a nice snapshot of the data coverage available through the white paper, and of course through Upply's data collection as well. Thomas, would you like to update any of the audience on any changes that have been made to the coverage recently?
Yeah, no, that's. I mean, this picture here is a very good sum up of what we will show in the coming slides, and what our experts will talk about in the fluctuation and the volatility of rates. What is quite important for us here is that we have collected in the past quarter and the past year more and more data from more and more providers, which is quite good because we have a very good snapshot of the market today, especially on the Western countries, as you can see, also in the north of Europe or northeast of Europe. We still have some lack of data, and this is important to know. On the Eastern Europe, in the Southeastern Europe. So if you are looking for some rates in Greece or in some countries that are borders with Greece or in the southeast, you can have some on Upply, but just make cautious. On the other countries, the data is very good, as you can see, and we'll see it later. We have very good insight on it.
Okay, thank you very much for sharing that, Thomas. So let's, I think, turn to some of the overall rate development here as well. And this quarter, we've taken a bit of a deep dive into one of the sort of underlying dynamics of the market here, looking at market efficiency and how that's developing and changing. Andy, could you elaborate on that for me, please?
Sure. So we also want to show here that we have in terms of the benchmark rate per kilometer is 1.57 in Q1. That's up a little bit, 0.2% on last quarter and 0.8% year on year. So it's a similar story to the previous slides. The averages are done slightly differently, but it's a very similar story here. But yeah, so as you said, we also want to show that the rates on the front haul and back haul routes, and the way we define front haul here is the higher priced of the lane pair over the time period that you can see on the graph there, and the back haul is of course the opposite. So in theory, in a market where demand in both directions is perfectly matched with costs on both sides matched too, we'd theoretically see no difference between the front haul and back haul, but obviously we don't have that, that quote unquote perfect market. And front haul rates were priced at €1.72 per kilometre in Q1, back haul rates at €1.42 per kilometre. And that disparity, the figure between those two figures of 30 cents per kilometre, is below the long run average of 0.32 euros per kilometre. Now, that long run disparity includes the 2020 figures, which were characterized by lumpy demand patterns due to closures of different sectors of the economy in different countries at different times. And that led to a higher divergence in the front haul, back haul rates there. So the smaller disparity this quarter we're showing indicates the market shaking off some of that weakness we've seen over the past year, with an apparent improvement of demand on back haul routes. And we'll show an example of that one in some slides shortly.
Thank you, Andy. Yeah, it was very interesting to understand a bit more about how those dynamics at play, and of course also to understand that average rate per kilometre as well. So let's take that and have a look at how that maps across to some of the most high volume lanes. And we can see some of the rate development there. And actually, there's a few very interesting developments in the last quarter there, with a few of the backhaul and front haul lanes crossing in some of these lanes. So obviously lots has gone on in this quarter. Perhaps we could start, William, with a look at the Madrid-Paris lane to understand a bit more about how those dynamics are working there.
Yeah, Michael. As we can see, rates between France and Spain diverge in Q1, with the front haul rates to Paris up 7.9% quarter over quarter, whilst the backhaul rates fell 0.2%. So against Q1 2020 levels, the front haul rates were up 7.3%, whilst backhaul rates rose 4.4%. So the measures taken in the first quarter by the French government to delay the third wave of the COVID had a significant impact. Border checks with mandatory PCR testing, even if they did not concern the truck drivers directly, they created the feeling of a loss of transport capacity and automatically led an increase in prices between Spain and France. The repercussions were numerous. For example, the price of orange from Spain soared to 1.8 euro per kilogram in March at the Rungis market. You know, it's the largest professional food market in Europe, while it had never exceeded 1.2 euro per kilogram, so in the past 3 years. So even if we cannot put everything on the account of the transport, the increase in the price of product from Spain could locally have given the feeling of panic in this first quarter. So if we consider Germany to France, the rates on Franco-German lane suffered decline in the first quarter of the year. The front haul on the front haul to Lille, the rates fell 2.9% year over year, or 5.5% quarter over quarter. So the traffic between the Ruhr and Hauts-de-France, the regions, is heavily influenced by the flow of automotive parts. So since the beginning of the pandemic, volumes have experienced an extreme downturn. Although they are increasing again this quarter, there has been a drop in transport prices due to a delay effect from the large calls for tender issued in the last quarter of 2020 by the very powerful purchasing departments of the automotive suppliers. So this mechanism should not last for the second quarter.
Mm-hmm. Thank you, William. Always very interesting to hear a bit more about some of those sectoral dynamics that play on some of these lanes there. Andy, could you comment on Duisburg-Warsaw for us, please?
Sure, and you can see the kind of the most interesting part about this is the Duisburg-Warsaw rates have overtaken the price for the backhaul there, and that's one of the reasons we saw in the last slide the front haul rates and backhaul rates were converging overall. But for this lane specifically, there's a couple of short-term and a couple of long-term dynamics playing out here. Over the short term, we can see Germany's seen tight restrictions this quarter, starting back in December, which has depressed import demand. But conversely, Poland looks to be in a bit of better shape. Retail sales were 3.6% higher in February, so that's been very strong, and that's key because consumption goods account for close to 40% of Polish imports from Germany. So that's really key there. But over the longer term, we look at, say, German manufacturing, which has been relatively stagnant. So kind of pre-pandemic, over 2014 to 2019, manufacturing production grew at a compound annual growth rate of just 0.4% per year. So that's depressing its import demand for German goods being made there. But Polish wages grew by 5.4% per year over the same time period. So that kind of consumer demand has strengthened over that time frame, and that's led really to where we are now with a reversal in rates. So there's a couple of dynamics at play there, a little bit short term and a little bit long term as well.
Yeah, very interesting to see how that one develops, and if we revert back to normal circumstances in terms of the front haul and back haul rates in the future. So we'll keep watching that lane. Now, I think best to turn now to some of the major themes of the last quarter or so, and probably one of the biggest headlines, of course, was on the impact of Brexit, and we've spent years waiting to see what impact this would have on the cross-channel freight flows. So it'd be really interesting to investigate that. And in this chart here, we have a comparison really of UK and European rates. Andy, could you explain the trend shown by the graph here?
Sure. So yeah, we wanted to show the divergence in the rates specifically. So the grey line is the Europe rates, which without anything UK related in there, and the red line obviously is just the UK rates, and they're up 1.3% quarter on quarter and 5% year over year into Q1. So overall demand has been depressed, but trade barriers have had a clear impact in increasing freight rates at this time. We saw at the beginning of the quarter, a number of major road freight providers were forced to suspend operations temporarily due to paperwork being filled in incorrectly. According to an ONS survey, just under 40% of traders had identified as their main hurdle to trade. There are also reports of more carriers crossing the border empty due to issues with the regulations, finding that just an easier way to cross the border rather than to take a load and potentially be stuck there. So that squeezed capacity as well. Also appears that many shippers have been caught out by the rules of origin requirements too, which means that goods have to be sufficiently qualified as being made in the EU or UK to qualify for tariff-free trade. So again, that's caused more friction and more complication there as well. So these issues have they've held up carriers, they've caused greater supply chain disruption, and have led to an increase in freight rates into Q1.
Yes, I think that's it. Always just comes down to preparation, which is very difficult for our industry, of course, when we had no idea necessarily what the circumstances were going to be. Remembering the sort of slightly farcical scenes of drivers having their ham sandwich confiscated on arrival in the Netherlands, for instance, in January. So a bit of settling down to that's required. But if we can move on to the next slide here, which actually takes a sort of look at rates over the different months, we can see the sharpness of that impact as well. Andy, would you like to comment on that?
Sure. So yeah, we can see initially there's been a bit of caution from carriers, and that demand that matched the demand situation as well. So according to the ONS, in January, UK exports to the EU fell by 41% year over year. Imports were down 29%. I mean, in February, UK-EU trade did increase significantly compared to the month before, but it was still down year over year. And as shippers returned to this lane, carriers increased prices as well. There's sometimes I suppose a lag in rates in terms of the situation on the ground and the price points. So in February and March, we really see the effects of the rate hikes and the congestion and the issues being seen at the border. In March, actually, the levels we see there are 4-year highs for UK rates. But overall, I mean, some of the teething problems do appear to be dying down. I mean, in terms of there haven't been the miles-long queues that were potentially expected. The Kent access permit, I mentioned that earlier, is no longer required for hauliers attempting to cross into Kent and to cross the border, since the Department for Transport was saying that 86% of hauliers were turning up with the correct paperwork filled in. So there's no longer a need for that. But overall, I think we're probably likely to see high rates continue into the months ahead, based on that momentum going into March there. The new trade agreement is undoubtedly created new border friction, and this is beginning to settle in as this is the new normal, really. So those extra complications, I believe, will continue to be priced in by carriers in the months ahead.
Yes, interesting that a lot of the disruption, I suppose, quite front-loaded into January, and we saw, of course, so much stockpiling prior to the actual Brexit deadline or coming into effect that there was not so much need for the volume over the course of January, but of course then we also saw a disruption from the COVID testing restrictions, and that masked perhaps quite a few of the problems as well. So very interesting to look at that. William, do you have anything to offer from the sort of continental perspective on the changes and the effect on the road freight prices?
Yes, Michael. What I can say about this graph holds in a few points. There is a fairly classic trend of transport price inflation between January and March in the UK, but what is unusual is the magnitude of this inflation. So, but as you said, we must take into account the COVID crisis, which severely affected Brittany Island in January and February. I do not yet know whether Brexit and specifically the absence of cabotage by continental carriers have created a lack of capacity in the market and had an inflationary effect by ricochet. But we will see what's going on, and I'm sure that we will be fixed for the next few months about cabotage.
Yeah, so that's certainly something that would be interesting to watch as we see the market develop. So we'll keep an eye on that trend as well. Finally, on the subject of Brexit, we also wanted to highlight an individual lane as well, which in this case shows the price increase very starkly from the last quarter, and that is to look at Birmingham-Lyon here. So William, do you have any comments to explain why the magnitude of that change is so substantial?
Yeah, freight rates from Birmingham to Lyon increased substantially in Q1 2021. So rates were 11.8% higher than the previous quarter and up 8.8% year over year. So according to the EONS, UK export to the EU fell 40% year over year, with imports down only, I should say only 28%. So how can we explain that the demand for transport dropped by 40% for export, that this drop is more marked for export than for imports, and at the same time that prices are increasing by more than 10%? If I believe the specialized press, the reason is quite simple. Carriers ask their driver to return empty rather than risk immobilizing the truck by administrative harassment from British Customs. The figures recorded in Calais in January confirmed the drop in capacity. More than 6 out of 10 trucks were empty from England. So I have to admit that seeing price soar between England and France because of Brexit was a bit counterintuitive.
Yes, but very much understandable when you look at how it really played out and decisions being made at road freight operators there. Well, thanks very much, Andy and William, for your insights on Brexit there. I think perhaps we should turn now to our other major theme, which is, of course, understanding the impact of new COVID restrictions over the course of this last quarter, and particularly looking at how the industry has really coped with that after the experience of 2020. In this case, we're looking at the example of Germany, which had coped very well, and seeing how rates are catching up in the rest of Europe, which had been suppressed last year more extremely by the COVID-19 crisis. But Andy, could you explain that in a bit more detail?
Sure. So yeah, I mean, essentially, this is really due to the worsening public health situation in Germany. Germany has obviously performed much better than other countries in the first wave, but that's not the case now. It's seeing very tight public health restrictions, which started in December and have continued through into Q1 as well. I suppose the caveat there is that lockdowns have been designed this time around to be less economically damaging than they were previously. So manufacturing, for example, they haven't seen the same factory shutdowns as previously. In terms of the supply side picture, it's not been straightforward. I think furlough schemes being used less in practice, but Germany has also implemented numerous border controls as well, which has led to higher border crossing times and more uncertainty as to the supply of road freight. But nonetheless, the convergence shows that Germany is having less of an effect in holding up the European benchmark rates than it was previously, with quite stagnant demand. So it's now the ex-Germany rates which are on the increase, with Germany rates falling over the last 2 quarters, and that's really due to the worsening public health situation there.
Thanks, Andy. And if we turn now to look at import versus export freight rates as well.
Yeah, so I suppose what we see here in a reverse of what happened in Q1, Q2 last year was the export rates are to be the stronger of the two this time around. That's really because of rising global demand and trade volumes, which have resurged and have grown very strongly, particularly towards the end of last year and into Q1 as well. And obviously, as a key manufacturer for the rest of the world, Germany's seeing a boost in demand for for goods going out of Germany, so that's increasing rates on the outbound lane. However, the import side is doing the opposite, and with the public health restrictions in Germany, we're seeing consumer spending and retail demand weakening. So that weaker demand is dampening rates. So as I say, it's a reversal from last year. It shows just really how different the situation is now compared to 1 year ago.
Yeah, absolutely. It's all change really, I suppose. But with William, do you have any comments you'd like to add on in terms of the experience of German rates, and also looking at the effects of the new lockdown restrictions across Europe?
Yeah, Michael. But I hope that many of you will forgive the simplified, or I should say, the simplistic view I have of the German import-export market. I used to schematize Germany as a big industrial tool which must operate at full speed. So Germany uses its European partners as customers and contractors. So when the market is strong, Germany concentrates on products with high added value and withdraws the rest from its partners. But when the market is weak, Germany reduces its external purchases to continue to run its industrial apparatus on products with lower added value. And this second case is clearly what happened in Q1. So due to the lockdown, imports have fallen compared to exports, and this generates this wide divergence on the transport price that we see between rising export and falling import.
Well, thank you, William. And I think perhaps our next slide as well, which is looking at one of the biggest price changes over the last quarter, may show that if we're looking at flows from Germany to the Czech Republic, what do you think's behind that change, William?
Yeah, rates from Duisburg-Prague jump 9.8% year over year and 8% quarter over quarter. So the surge in transport prices noted between Duisburg and Prague is a consequence, in my opinion, of two problems. So the first is the one I commented on the previous slide, namely the reduction in German imports, which mechanically increases the cost of transport of the export. So Duisburg-Prague is obviously an export flow considering a German point of view. And secondly, border restriction at the German-Czech border. In order to reduce COVID-19 numbers, Germany has implemented requirements for drivers to deliver a COVID-19 test 48 hours before crossing. So as a result, queues of up to 20 kilometers have been reported. So there is no doubt that many Central European carriers, I mean lower cost hauliers, have cut back on trips to Germany. As a result, the price mix was affected upwards. So I call that the double penalty, and we must underline that Czech Republic with Hungary is one of the countries most affected in Europe by the COVID crisis.
Yeah. Absolutely. Well, thank you very much for that, William. I think it really underlines, if we think through all of the individual lanes that we've covered today, and the reasons influencing growth are so intertwined with the COVID restrictions and the effect that that's had on overall demand as well, and then also the disruption at borders really shaping road freight rate development for the last quarter. And it's been really interesting to track that over the course of the last few months with the data for the white paper and from Upply. And deliver these kind of insights. I think it would be quite interesting as well just to go into maybe a bit more detail about the methodology. I can see that there have been a couple of questions asking about the sample size for these rates and that sort of thing. So Thomas, would you be able just to give a quick outline of the methodology that Upply takes?
Yeah, with pleasure. I started at the beginning to try to explain how we collect data and what this kind of data we have. So the key point is that we collect market data from transactions, from invoices that we get from our partners and from our users. There was one question regarding the amount of data that we have. So I answered directly in the chat, but for everybody, so we have a bit more than 300 million of data across all modes of transportation, and we have a bit more than 120 million of data in Europe, only in road transportation in Europe. And so it means that from our point of view, we are representative of the market on many corridors. And then for the one I talked at the beginning, in certain countries, we put directly on our website, okay, cautious, here we have a few data, so be careful with the rates that we can give. But this is only for some European countries and mainly in the east and southeast of Europe.
Okay, thank you, Thomas. Well, I think it's time then perhaps to move on to our Q&A session. So please do, if you haven't asked a question already, feel free to submit your questions to the panel here via the Q&A functionality, and please feel free to ask technical questions about the data, but also market questions about trends as well. If we look at the first question that we've got here, we've got an attendee asking, what is the forecast for the coming 2 quarters? How do you expect prices to develop, and particularly in terms of UK imports? Andy, would you like to have a go at answering that one first?
Sure. So I see. I think we're, despite Q1 being a pretty difficult quarter in terms of the public health situation, it does appear that underlying demand is likely to improve in the quarters ahead as the rebound from COVID continues. So that looks like a positive for the market, but it could lead to rates increasing overall. I think we've also seen, supply chain disruption, the issues we've seen at, say, ports at the moment, and the difficulty that haulers are having getting into ports and getting out, creating additional, takes additional time, creates additional cost. I think that's going to be priced into the market as well. So I'd expect to see increases into Q2 and into the quarters ahead as well.
Mm. William, would you like to offer any comments on expectations for the next quarter?
Excuse me, I was on mute. But I can just say, like, experts project a strong recovery in the economy for the second half of the year. And so under these conditions, I think it's a safe bet that transport is running at full speed. So yes, we will find the same problem as before the crisis, or shortage of drivers in particular, and so on. So transport prices will go up. So and this is also the bet that TLP, so it's a Polish Employers Union, is making. So I think that now we are in period of pre-inflation of transport prices.
Okay, thank you very much, William. I think we'll have another question from the audience then, and we can look at. We've got another question here, which is asking about Brexit, actually looking at how much of Brexit is, the effect of Brexit is already priced into the freight rates that we see here, and the expectations around what happens if the trade imbalance shifts. So I suppose that might be an interesting question for you, William, given some of the points you were making earlier, on how much more we expect prices to change on the Brexit lane, or do we think that the increase that we've seen already is the full extent of the increases we'll see?
But I understand the question of Dr. Ananasi. This is maybe sorry for my pronunciation. I understand that how can we expect, in fact, the increase of prices that we see due to the Brexit will impact, in fact, the final deliveries for the market. And I have to say that at the moment, I don't think that you will see a real effect. But on the long term, it will be different, I think. So maybe yes, we can expect that we will have this famous increase at the final delivery. So this is what I translate when I see LTL hauliers belonging to multi-user networks.
Okay, thank you, William. We've got another very quick question there as well, so just answer quickly about sharing the PowerPoint slides. Yes, that will all be shared after the presentation with everyone, so don't worry about that. Now turning to another question here, we've got a question about container shortages at European ports and what effect that may have on road freight rates. Andy, would you like to have a go at answering that one?
Sure. So, I mean, I think as I commented, it's taking longer for hauliers to get into ports and take those containers away. I think we've seen some of the German ports recently reporting of peaks of up to 5 to 6 hours going within the port to collect and to pick up a container and pick up the new load there. So it's I think this is going to be something which we increasingly see over the next few months. It's obviously a real problem in the US at the moment, but it's likely to continue as an issue in Europe as well. To extent as well, this affecting a similar story in air freight capacity as well, and all of this kind of puts that pricing power towards the carriers as well, who will have a bit more. There'll be more of for the shippers, they'll be looking to get goods moved as quickly as possible, and the carriers will have all the power in that price in that as well. So that'll likely lead to increases in rates.
Thank you, Andy. Yes, that's very interesting to see the effects of a container shortage there and how it actually influences prices overall. We've got a couple of slightly more technical questions here about Upply's coverage, asking about coverage in Portugal, for instance. Thomas, would you like to answer that in terms of data available for Portugal?
Yeah, I mean, not in this presentation, but yes, we have data from Portugal to Spain, to France, or to some big countries in Europe. We have data, of course, and we'll be happy to have a look with you if needed.
Thank you. So, if you have got more questions about the road freight rates, then please do get in touch with the team at Upply. They'll be very happy to talk to you about that. And of course, if you have wider questions about the development of the European road freight market, then do please feel free to get in touch with us at TI to talk about the market's development. You can see contact details available on the screen there. I think we've got another question here, which is maybe a bit more general in nature, which is looking at overall volume development in Europe and our expectations for road freight volumes and how that links up to rates in Europe. I think we probably hope that after we come out of this third and hopefully final wave of the coronavirus restrictions, that demand and volumes will pick up. But William, do you have a view on where you think volumes will go later this year?
No, in fact, the recovery is planned or forecasted for the second semester. So we can expect back in September the volumes will be. I think that the raise will be around 5 or 6%. So the consequence about the price will be very strong, I think. If I compare to 2018, 2019, and 20, of course.
Yes, absolutely. And actually, from TI's perspective, our market forecasts for the European road freight market show a market recovering quite strongly through 2021 as volumes recover, and then also out to 2025 at reasonable growth returning. So we do expect to see the market develop. And obviously, if you want to read more about overall market forecasts and expectations, then again, you can contact us at TI to hear more about that. Okay. I think we've got a couple more questions here talking about some of the things which have been addressed during the course of the webinar from late joiners. So I think we may have finished any or all of the questions. So I think in that case, that leaves me just to say thank you very much to everyone for tuning in to listen to the presentation today and learn more about freight rate development across Europe. And of course, to thank our panelists, Thomas, William, and Andy for giving their views today. And just a last reminder, of course, you'll all be sent a copy of the presentation and the slides after the webinar. So thank you everyone for joining us, and we'll see you next time.